We are now live on our various social media platforms. We've got a number of attendees um, here live with us on Zoom. Again, if you're joining us on any of our social media platforms and would like to come into the Zoom session for future events, please go to cpa4it.ca and register for the event so that you can join us via the Zoom. For those of you who are here in the Zoom session, you can use the Q&A and we will do our best to answer your questions as we go throughout the session. If you are on social media, you can post a comment and team members of ours will relay those comments over to Chukwu and myself, and we'll do our best to answer those. If we happen to miss any of them, we'll come back and answer those down the road as well. So first and foremost, I want to thank Chukwu for joining us again today. For our second session on best practices for real estate investment. For those of you who don't remember, Chukwu is a broker with Sherlock Holmes, and he was kind enough to bless us with a presentation almost a year ago now, I guess, and talking a lot about investing in markets like Mexico. And we thought it would be great to have Chukwu back because there's a lot of changes in the market in a year. And particularly here in Ontario, we've seen some massive corrections to the condo market, which mean potentially buying opportunities for those of you in the market. And many of our clients who have done a great job of organizing their finances and creating wealth are now looking for opportunities to, invest that wealth and to use that as a legacy. And so we wanted to take this opportunity to talk to you a little bit about some of the best practices in investing in real estate. And Chukwu is definitely our expert on real estate. I'll do my best to be your expert in tax. And there are some benefits potentially of investing via your corporation. It doesn't necessarily mean that investing through your corporation is always the right idea for real estate. And happy to talk through individual scenarios, but what I would say as the guiding principle is before you make a large investment in anything, please have a conversation with your account manager or your accountant and see what the best way to structure it is for your individual situation. Now, some of the things that we do like about investing in corporation through a corporation is the ability to reinvest into the property. Like if you've got a property and you're carrying a mortgage and you want to pay down that mortgage, if it's owned personally, you've got to suck that money out of your corporation where you're earning it, pay higher tax rates to be able to pay down that mortgage. If it's inside your corporation, you can pay down that mortgage without having to take that money into personal income. So it's got some tax advantages that way. Now, on the flip side, if the house is completely paid off, then investing inside the corporation may not necessarily be that much better because unfortunately, passive investment income is not eligible for the small business deduction rate that you are used to paying here in Ontario of only 12.2%. So it's closer to about 28% on what you'll pay on passive income, which is not bad, but obviously not as good as the 12.2. So what I would say is we're going to talk a lot about a lot of different ideas, whether that's, investing in condos, investing in commercial properties, investing in student housing, investing in foreign countries. Before you jump into things, I would say make sure you have a conversation with your accountant whenever you're making any large life decisions to make sure it's structured as efficiently as possible. But again, we should give the floor to Chukwu, who can tell us a little bit more about, what's taken place over the last year when it comes to the real estate market. Let's talk maybe here in Ontario. Obviously lots of news of houses sitting in inventory longer than ever before, buyers not showing up the way they have in the past, and this being a potential buyer's market. So can you tell us a little bit more about what's going on in the market here in Ontario?
Okay, no problem. I should probably change my name here online
From Sherlock Holmes to Chukwu?
from Sherlock Holmes to Chukwu. Give me one minute. My name is a little bit difficult here. So I'm going to change my name to Chukwu. It's pronounced Chukwu Uzoruo. Make it a little bit easier. Okay. Thank you so much, Andrew, and I really appreciate being a guest on your panel today. But what I can see, what's happening is that the current market is experiencing one heck of a slowdown. So it's not it is a buyer's market at the moment. And from what we're seeing is that this happened primarily due to the effects of the tariffs, right? There's a lot, well, partially because of the tariffs, there's a lot of uncertainty when it comes to buyers. Usually, whenever we're looking at buyer sentiment, we also try to understand exactly what is actually motivating the buyer to actually purchase something, right? Sometimes it's going to be low interest rates. Sometimes it's going to be job satisfaction. Sometimes they believe where the economy is going to be heading, right? It's almost, think of it almost like an investment. So you have some people who are buying a property because they need a place to live. But at the same time, there are people who are buying up and they're some that buy a place strictly for investment purposes. And there are many people that do both. They don't want to just buy a house for the sake of buying a property. They want to buy something low, like everyone else, and they want to at least sell it high or at least have some sort of equity, right? Now, you have to look at the seller as well. The sellers right now are trying to make as much equity as they want. And like most people know, it's a waiting game, right? If interest rates continue to drop, then more than likely there's going to be increase in prices, right? So for a lot of sellers, they're actually waiting. So the ones that you're seeing on the market right now that are coming on board, they're the ones who are panic selling. They're probably in a position where they can't afford to maintain that property, or you have some of them that might be seeing that there's an opportunity for them to actually downsize and get something else or move around, right? So in terms of, so that's what the market is really looking at right now. It's pretty much stagnant, right?
Right.
You have sellers who are desperate trying to sell to put the houses on the market because no one who can afford to keep their home is just selling for no reason. It doesn't make any sense, right? Or they don't need to downsize. It doesn't make any sense. And then you have buyers. Some of them are sort of try to figure out whether or not they should buy a property or even consider renting. Because as we've seen in the GTA, rent prices, especially in Toronto, have actually gone down, right? So that's why in their brain, does it make more sense for me to rent a property right now? It's a bargain. There's tons of rentals on the market right now because they're not selling. Or is now the right time for me to buy a property? And if that's the case, what property? And if the prices are going down, when exactly should I buy? If I buy it now and it goes down by 20,000, right? So everyone is sort of like waiting for that time for it to sort of kick off. So sellers don't want to sell or sellers can't sell, and buyers are just waiting for that right opportunity or the perfect deal. And not every seller is willing to accept anything. So it's almost like a stalemate is what I'm seeing so far in the market.
Yeah, and so yeah, everyone's just holding, trying to figure things out. But I guess that in there lies the opportunity because we are starting to see, like you said, days on market go up for
Correct.
how long houses are sitting for. Which yes, those who don't have to sell will just let it sit there. But there are more and more people because the economy being forced into selling. We hear horror stories of people who are completely upside down on pre-construction homes that they bought that are, hundreds of thousands of dollars less than what they're paying,
Yes.
you know.
I can talk about that market very quickly. So if we're speaking about condos, some of the best discounts that you can actually get would be pre-construction assignments. So I don't know if your viewers are familiar with assignment deals versus a regular residential, but I know in some markets I'm seeing like, okay, so the way I don't even get into that really quickly. I'll give you the quick version. So right now, if you were to buy a condo in a normal, typical residential market online, you might see it selling for $500,000, and that's pretty much it. You put down your 5%, you get your property, and that's pretty much it. Then you have some people, what would happen is that they might be another investor. They might have purchased that property maybe for $300,000 about 5 or 6 years ago in that general area. It might be about to be built. It could have, more than likely, it's going to be completed. It might be completed in about a year, but they might actually willing to actually give up, not only just give up the entire deposit, they might be willing to even give up a portion of the deposit. So let's say that property is worth approximately 500,000. They put down they bought it for 300,000 and they put a deposit of 200. You might have cases where someone might say, you know what, I just want $50,000, 50 grand. Let me just get out of it altogether, right? So the assignment as an entry, if you're holding on to a lot of cash, so let's say if you have like 80,000, 100, 200,000, And the property is going to be closing soon, right? And I would say, I mean, almost completed, right? I wouldn't recommend you going for something that still has another 3, 4, 5 years. That's too far in the future. But maybe even if it's next year and closing next year, and you can see like it's actually built, it's almost done. That would actually be a pretty damn good investment right about now. We've had some markets where condos have pretty much, it's been very similar to this. I know it was in the 90s. I remember that where people were just giving away the condos. I know it happened after COVID, and now it's happening again, but things are a little bit different because the interest rates are extremely low compared to back then, right? But yeah, definitely condos can actually make a lot of sense, but I would definitely stick with the assignment first. If you can find a really good one, you can make a lot of money right off the bat because you have instant equity. And then afterwards, you can look at resale condos, but it has to make sense. I'd recommend looking for something that's at least a 2 bedroom minimum. Right? I would never get a 1 bedroom or studio. They're terrible investments. And you also have to be mindful of like the direction that it's facing, whether you have a balcony or no balcony, etc. But two
Right.
bedrooms, 2 bathrooms, if you're going with condos, that's where you want to go with a balcony. And definitely not on the main floor.
Definitely not on the main floor, you said?
Yeah, so if you want to sort of think of condos, right? Okay, some of them on the main floor can work. If it's on the main floor for people who are elderly, those one make a lot of sense. But let's say, for instance, the math that I use is that if you have 10 stories, cut it in half, right? From the fifth floor down, it doesn't make any sense, right? Because most people are buying condos for a view. Now, if
Right.
you go from the six above towards the penthouse, they tend to sell for a lot better. They're easy to sell. And if you can add that to a nice view, those ones will get you a much better return. So you have to consider the view, whether they have a balcony, direction it's facing. And it's not just about price. If the vision is obstructed, you can't see like the city or whatever it is, there's another building right in front of you, definitely avoid those ones. They're very difficult to sell. But yeah, the main floor is not so bad. It's a specific target market for those. They tend to be elderly or people with some sort of like disability where they can't really go upstairs or afraid of heights. But when you start going to the second, third, fourth, fifth, etc., not good. Very difficult, especially in a high rise. In a low rise, not so much, but a high rise, definitely.
That's interesting. Now, so the condo market is definitely a unique one, but one of the other ones I was interested in, I don't know if there's more you want to share about the condo market, and timing, because I guess the issue, if you're looking at the condo market as an investment opportunity, I mean, if you're looking at a home for one, that's obviously a no-brainer. But if you're looking to rent it out and rent prices are coming down, what are people seeing as far as cap rates on, condos as far as a rental business? Because Airbnb is, basically gone from a strategy because they
From
have
Toronto.
eliminated, for Toronto certainly, and for many areas, because they've eliminated all the tax benefits of doing so. And for those people who aren't aware, they're, unless it's registered, you your Airbnb is not going to be eligible for you to deduct expenses against the income, which means you're paying tax on all of it, which basically is government's way of trying to eliminate Airbnbs to free up the market so that there's more availability for living. But for those people who are looking at investment properties, maybe you get a great deal, but what's the rental market like? And how difficult is it going to be to get the apartment filled? And what are your cap rates going to be, compared to what they've been in the past? Because I know typically they said in Canada cap rates are usually about 3 to 5%.
Yeah, that's
Uh,
about right.
yeah. And have they gone down? Are they staying consistent?
I haven't checked. I'll assume they went down, but I haven't checked in a minute. It's been a while. Usually for our team, we sort of like target areas where the money is at, and condos we don't target them right now because usually we list, and to list a condo right now, it's rare that it's going to work out, and
Right.
then we don't have too many investors right now rushing for condos. The only ones that we've seen looking for condos now are new homeowners, like university graduates, someone who's just starting a family, just starting out. They're not really looking at as an investment portfolio. So there hasn't been a need to um, check for cap rates for any condos probably within the last year. I can look into it and see what it is, but we haven't had the need. It wasn't necessary. No one's
Fair,
buying condos for the last year.
fair enough. So people are generally, that market is a difficult market, although it's a great opportunity if you're looking for a new home for a fresh grad. Now, speaking of grads, one
Mm,
of the things I always talk to people about is when it comes to real estate investing, from a tax perspective, there's nothing better than the basic exemption, your primary home exemption, and being able to get the capital gains completely tax free. And so
mhm.
one of the strategies I plan to use myself, and I encourage people to do as much as possible for creating generational wealth, is when their kids go off to university, if you can help them to purchase a home in a university town, there is a tremendous opportunity for them to grow their individual net worth because they're getting into the real estate game early. Your property is going to appreciate. Plus, while they're in university, they can rent out rooms to their friends and potentially have some additional, cash flow from that. So, what's the market looking like for university towns and those types of uh, investment opportunities?
There've definitely been, and there's normally always a strong demand for student housing. I think the only time that I saw a bit of a downturn was when the government was pretty much attacking students, but not attacking students. It affects immigration, that they were
Yeah, the
reducing.
foreign students. Yeah,
Exactly. So that had a direct impact on the student market, but there'll always still be students trying to attend the universities. They just have a bit more choice. So like I would say probably like 3 to 4 years ago, yeah, a student housing can just walk in there, just buy one. You don't really care about the condition because you know you'll be making a lot more money. Now you have to be more mindful of location, how close it's going to be, etc. And it has to be presentable. But yeah, student housing traditionally excellent. One of the best ways for cash flow. You tend to get your money in advance. The I personally I like it. I think to me it makes sense. They don't appreciate that quickly from what I'm seeing. So I would say like you don't really look at it in terms of asset appreciation. You look at that one more for cash flow more than anything else, right? Um, I've seen people do extremely well, like extremely well with student housing. The only thing that they have to be mindful of, it's something that's very hands-on. So if you're not going to be hands-on, then you better have a good property manager or someone very responsible in it. But for a child, like for your own child, if they're already going, to me, it's a very good move. It's a very smart move. It gets
right.
them directly into actual responsibility. I would probably give them a bit more have more expectations with that child than anything else. Like you're responsible for collecting the rent, which is excellent. You want to be a landlord. You're responsible for any sort of repairs. So I mean, if you're a homeowner, you need to know how to get things done. And you're also very responsible for keeping the peace, making sure that everything becomes stable and everyone's behaving themselves. So I really like that approach. I never thought about it that way before. That's a very smart approach. It's a good one.
Because there you're getting into the market, you can help because typically if your kid's going away to university, one of the bigger costs is going to be the housing more than
True,
the tuition. And this is a great way to mitigate that cost because you can basically get the place completely paid for by the other tenants,
true,
um, and then still have some appreciation. But you're right that with those university towns, the appreciation isn't there the way it is historically in cities like Toronto or major urban
true.
centers, but you're also usually getting a much better cap rate.
Yeah.
And so you're getting a better cash flow. Um,
Mhm.
and again, a great opportunity. I know one of my most successful friends is a friend
Mhm.
from university that bought the house that a group of our friends lived in. And he now owns 38 different properties around the world.
Yeah,
And has just gone up from there. And it's a great way. The reality is, unfortunately, in this day and age, your kids probably aren't going to afford that place without the help from the bank of mom and dad,
yeah,
and a deposit. And looking at ways that we can structure that, there are ways to do. If your children are working for the business, we can do employee home loans as a way to get money out of the corporation to fund that, because that would be an investment held personally by your child as opposed to um, by your corporation. But it's a great way to transfer wealth to the next generation. It's going to appreciate. It's going to appreciate under their name, so you're not
true.
worried about any estate tax on death or anything like that.
Mhm.
and teaches them fiscal responsibility, right? Which
Yeah.
is, absolutely critical for children. And it's at a time where you're still available to, step in and help them and teach them the ropes where necessary. Are you seeing any areas that seem to be better opportunities across the province than others? Is, Kingston better than London, or
In terms of student housing?
there's a student housing? Absolutely.
Yeah, I don't really see anything that's really better. I haven't looked that hard, but I know that for some reason we kept on getting investors from Kitchener. So I think like throughout last year, nonstop, we kept getting Kitchener. I know years before we will always get Niagara, like Thorold. That was something that always came up. I haven't really seen anyone look for something in Toronto, which is actually kind of in the GTA, which is sort of surprising, but normally tends to be on the outskirts. So Kitchener is one I've heard about a lot of times,
Yeah,
very, very consistently.
that's a great town. What would be the starting point to get into a property in Kitchener these days? Obviously
I
not
would,
as much as Toronto, but not
I would
probably as
have to,
much discount as everyone would like.
I would have to triple check. I know I'll guess maybe 600,000, seven around that range, but I'll have to like
Right.
pop in and check. I know that back in the, like years ago, we would find like 400,000, 500,000, depending on like a bungalow and all that. Like you can find something like that, but you'll need some work. But nowadays, yeah, I would probably say closer to the 6, 7 range. You should be able to find something that would be good for housing. The other thing that I should also bring up as well, Hamilton is another, Hamilton, well, not student housing, but Hamilton's another good one as well. It's also about the, what do you call it? Not the zoning, but the legal basements and all that, right? So I know that recently, a couple of years ago, they've been a bit more harsh. The government's a bit more harsh on zoning, fire zoning laws, etc. I know like 5, 6 years ago, it was at the Wild Wild West. So you can probably take a basement, make 5 bedrooms down there and rent it all out and be fine. But nowadays, you still have that risk. One thing that I will tell you that the risk of having a student rental that is most of them are not legal basements, by the way. I'll tell you that right now. The risk of having a place that doesn't have a legal basement is that if anything were to happen, like there's a fire or anything happens, you are 100% liable. Insurance is not going to cover you, like you're on your own. So you have to be mindful that if you're buying one with that is not a legal basement, which is a lot of them, most of them, that is the only risk you're going to take. And the ones that do have legal basements, they are going to be significantly more expensive. So your cash flow is going to be reduced. So it's a bit of a gamble in between, whether you go for what you tackle the cash flow, but you take that risk, or you go for one that's completely legal, but you definitely get less cash flow. It's going to be more expensive.
Right, right. Yeah. So that's a trade-off you've got to make. And so you say insurance, it won't even cover you. So you're probably paying insurance, and then you run into an issue and you're SOL. Is that whether the fire starts in the basement or just period?
It
There's a legal break.
um it depends, right? Because if you're dealing with I mean, you better hope the fire inspector doesn't come along. That's a whole nother problem. But yeah, you'll have a very difficult time. And even if insurance does have to cost you, I don't know, there might be criminal charges as well. I think there was something that happened not too long ago where someone died in an illegal basement. I think they got charged. I have to look into it a bit afterwards, right?
Yeah,
But I mean, think of it this way: you cram a lot of people into a basement. You don't have, you're not following the laws and all that. You don't have any sprinkler systems or anything like that, and something goes wrong. Who's really at fault? It's not going to be the student.
yeah, absolutely. And yeah, and no, that's definitely a risk, and also the other risks are, tenants not paying, having to deal with the landlord tenant board, which is a whole nother issue. So there are definitely risks associated with real estate. There's no doubt about that. But
Oh, at one point, sorry,
yeah,
I did get one thing. The student housing traditionally doesn't go under the LTB, right?
oh, it
So
doesn't.
yeah, if you put it properly, right, it's not going to, like, because it's a shared space, right? So if you have a shared space, or the landlord is sharing a space, and they're sharing kitchens and stuff like that, no, and how you structure it doesn't have, it wouldn't fall under the LTB, right? LTB normally gets involved if you're if it, I know I get to that afterwards. If it's not a shared space, but normally in this, there's a bit of a loophole there. I know this is being broadcasted. I don't want to ruin things for a lot of people, but no, traditionally it's not. There are ways you can get around it, and it's not that difficult.
That's interesting. So that makes, the potential student housing with your children an even better opportunity for sure.
Yeah. Oh,
Yeah.
yeah.
And I guess what a lot of people do is typically they'll buy one house, and then two or three, and then grow, and keeping them all in that same student area. I noticed that that's how my friend did it. I've seen other people who've done sort of similar strategies. I guess that's obviously because if you're having to be the property manager for these, having them close together makes it a lot easier. Um, but there are opportunities to bring in property managers as well. It just obviously eats into your cash flow. Now, we do have a question that came up here a little earlier. I was saving it for the person who asked. He said, is passive rental income not regular passive income for tax purposes and therefore taxed at 50.17%? And they are actually right. The general rate is um, there's basically a whole bunch of add-on taxes. But yes, the total tax at the end of the day on rental income would be up as high as 50.17. So like I said, um, you're not getting the small business tax rate by any stretch of the imagination. But again, remember that you are able, if as long as it's not an Airbnb that is, not allowed to deduct expenses, you're going to have all your costs to operating, which include your carrying costs for your interest on your mortgage, assuming you have one. And so typically, like we said, cap rates, and by the way, maybe we should explain what a cap rate is, but cap rates are typically only 3 to 5%, which means that's your profit that you're generally making, and that's before your interest on the property. So once you factor into interest, most properties now you might tell me, Chukwu, that the university or student housing has much better cap rates, but typically most of these properties aren't actually generating a cash flow profit when you factor in interest. They're only generating a profit if you are free and clear and you have the money to put down and you're not borrowing money to invest. So
Okay, yeah.
even
Mhm.
though the tax rate is 50.17%, typically you're not actually having any taxable income or very little from these properties once you factor in your carrying costs. But they are absolutely right. The full tax rate is going to be 50.17% inside your corporation, which depending upon your tax bracket could be more or could be less. If you're over 220, that's actually lower than your personal tax rate. But again, these are the things that you want to look at with your accountant to determine, hey, is this an investment property I should own personally or in the corporation? Pardon me, guys. Sorry about that. So definitely, lots of tax considerations, and it's going to vary depending upon, what is the cap rates, what's the rate of return, what are you borrowing money? Are you not borrowing money? Um, do you have money inside your corporation sitting unutilized that you want to utilize that you would have difficulty getting out? What's the tax cost to get that out? There are a lot of factors going into the structure, which means ultimately I'm not going to be able to give you an answer unless you give me a specific situation as far as how to structure it. So again, if anyone has any questions or any specific situations that they're looking to go at, we'd love to hear from you. So please post those in the Q&A and we'll do our best to address those. But now, Chukwu, with the real estate market, for people who are new to it, are there certain red flags they should be concerned about when they're looking for investment properties? I know you talked a little bit about condos, making sure they're on the right floor. Um, so first of all, I guess maybe right now, what would you be your top recommendation for an investment property, and what would be the red flags that you'd be looking out for to make sure you're getting the right property?
Okay, so whenever I'm looking for a property, okay, it depends on how you are. A lot of times, ideally, what I would personally do is that I try to find a property with as many, they keep saying doors, as many doors as possible. I want to get as many people that would be able to rent in that property as much as possible. So that's where like 3 stories, 4 stories tend to make a lot of sense.
Right.
Now, that's pretending you can't afford anything below a 4 story and below is considered to be residential, right? By the way, 5 and above is commercial. Anyway, so I would see if I can afford like a 4 story as a maximum and try to get as many, if they're all 2 bedrooms from all the way down to the bottom, to me, that would be extremely important. You also have to look at whether the area is hot, whether it's being leased, the condition of the property. Um, and your whether it's been appreciating over the last couple of years. So the last time the market was down compared to when things reversed, how much appreciation did you have, right? So that's what I would typically look at. The other thing, depending on how your mindset is at, if you're the type of person that is okay with renovating, I personally like fixer-uppers in these types of markets, right? The reason why is that usually whenever you find a property that's already completely redone, right? There's going to be, of course, the base materials, and there's going to be a level of profit that the contractor is going to make, and the homeowner is going to expect by renovating that
Right.
property. If you have trusted contractors, if you know what you're doing, I would look for those properties that are definitely fixer-uppers or partially completed, and those are the ones that I would go towards, right? Because they run out of money, they're probably desperate, and they just want to offload it. And as long as you can compare the finished product, like what a finished property would look like, those are the really good buys that are out there. So if you combine properties that can be renovated with those in a market that has a lot of demand for renters, and you have as many doors as possible, it's very difficult for you to lose.
Right. So you had to have an eye and a vision for what the property could be.
Well, yes, exactly. And you need to have sort of, how do I say this? If you're if you're the type of person that needs to renovate a property to get an additional equity, you need to understand like the cost of material, you need to understand the cost of labor, you need to understand the rental market in the area, you need to understand how many days before it can actually get rented, a very good grasp of how long before it gets renovated, the time span. You need to be aware of your accounting, the cost of borrowing the money, and everything like that. So that is a bit more complicated, but if you have the right people around you, you have an accountant, a tax person, a mortgage person, a financial advisor, etc., around you. That's why everything is about your sphere. If you have the right and a good contractor that doesn't lie to you, if you have the right people around you, then this can actually work out really well. Where things get very, I'll call it sketchy, it's when you can't trust them. A bad contractor can ruin everything for
Yeah.
you. Right? The same thing as a bad financial advisor. If someone's lending you money and you don't understand what it is that you're looking at, that can completely ruin you. So therefore, the team of people that you surround yourself with is it's gonna have a direct impact on how well you actually do in this business.
Right. And that's, I mean, brings up a whole nother question because finding good contractors, not only like, so you might have one in your pocket, but if he's lined up for the next 12 months,
Yep.
um, you don't want to be buying a property now and not being able to touch it because time is money with these properties. And, the faster you turn around that construction, uh, the lower your carrying costs and ultimately the higher your rate of return. What's it like as far as, the, construction market out there and being able to find, because I know that there have been periods where you just really couldn't get people to come in and work on your place no matter what. There was just too much demand. I'm not sure myself what that market looks like for, tradespeople these days. I'm not seeing a ton of construction out there, and I'm assuming with people being in that fear mode that, the capacity for building it, bringing in a construction crew is better. Are you finding that's the case, or what's the market like for getting tradespeople in to work on properties these days?
I've never had any issues right now. So far, it's been fine. I think that when you have reduced, you have less new builds being built nowadays, and less major renovations, and people have less money to even invest or do anything. There isn't going to be as much work. But I'll always say that trade is probably one of the most consistent jobs or careers that you can ever find. I have a deep respect for it. Yeah, but as you said
Make more
earlier.
than lawyers or accountants these days.
Oh man, like honestly, I know one of my best friends, he is a electrician. And yeah, he makes probably like triple, four times the amount as I do. You should really actually, it's good money. But yes, having a good tradesperson is very important. But at the same time, if they're really good, the odds of them being available to you, it's very slim to none. So that there needs to be something in for them. So a lot of times when I work with them, we're doing these sort of projects, I try to get them vested into the project. So I would say like my advice to you is to don't just hire them and be done with it. Make them into a partner and give them something to gain. That way they make it more of a priority. So if you're willing to say, okay, fine, if you do this or whatever, you get a return whenever we sell the property. If you can get a partner like that, then that will now be priority because they'll make whatever the cost is. They'll be cheaper in the long run, but they're vested in and you can make more money in the end.
Right, that's an interesting approach. Um, and talking about tradespeople and working on and building or updating your properties. One of the things my dad always taught me about real estate is that one of the keys to maximizing your return is to change the use somehow, some way of your property, whether that's
Okay.
adding more doors, as you expressed earlier, or maybe, switching from residential to commercial or single family to multi-family dwellings. What are, the opportunities there with, changing the use and adding more doors? Like, let's say that you buy a single family home and convert
Mhm.
it to a duplex or, a basement apartment and a main floor apartment. Are you seeing opportunities there, and what are the pitfalls and the things people should look out for if that's something they're considering doing?
Okay, so essentially, the first thing you look at is the zoning to see whatever it is that you're planning to do is actually permitted, right, in the first place, right? The other thing, okay, the easiest ones you can do is pretty much renovate a basement, but also involves permits and
Yeah,
everything along those lines, right? I would probably say that one of the most important things outside of getting permission to do whatever you want, making sure you can actually do what you're supposed to do, is not doing too much, is doing what needs to be done and doing it according to research, not based on your feelings.
right,
For instance, I've seen some people do like they'll have like a bungalow and they'll put one bedroom in the basement. Meanwhile, if they did some research, the one bedroom basement apartments aren't renting for that much. If they put the two bedrooms, then it might make sense, right? Or in some cases, it might make sense to have two bedrooms and a bathroom. Depending on your area, it might make more sense to do one bedroom and one bathroom, and that's it. So I would put more emphasis on research and making sure you know what you're doing and don't just guess it, right?
right,
A lot of times, a lot of investors, some of them are really good. They go according to their feeling, their gut feeling. Like, oh
right,
yeah, if I have a two-bedroom here, it would work out. But at the same time, you have to look at that property, see if it makes sense, and see if it will actually be working out in that market. And that involves a bit more, that involves research to see what's going on.
right. And I guess, is that where they would work with a broker like you to do that research, or how would they do this research?
Yeah, ideally. I'm not going to sell myself short, but yes, definitely. You need to have a realtor that knows what they're doing, that's good with renovations. A lot of times, like for me, I renovated like, at least a couple of houses already. I've finished basements for clients before, when I was much younger. So the thing is that if you don't know what the cost of that renovations are going to be, and if you have no idea, if you don't do research, if you can't tell like what would happen if I put a two-bedroom basement apartment, what would happen to my appreciation? How much more would my property appreciate by? That's not a calculation that's taught in the courses. Like you don't know that. And not to mention, how much more would my rent increase and then calculate to see if it makes sense. Because in some cases, let's say for instance, a one bedroom in an area is going to rent for 1,500, but a two bedroom might go for 1,700, but you're putting in $80,000 or 50,000 bucks extra to do those finishes. It may not make any sense if you plan to sell in 5 years. I'm sure you can do
Right,
some quick calculations, and that's a stupid thing to do. Just the opportunity cost. You might as well just do the one bedroom and then invest the rest, and who cares, right? So like you have to sort of like look at it that way and see if it makes sense, and someone needs to be guiding you in the right direction.
right, absolutely. And that's where a good professional who can do the research, because you've got access to data in LMS or MLS, and can pull stats and actually see real data and not use your gut, which if your gut's like mine, it's probably wrong half the time. Uh, and so that research is absolutely essential, and building that team to help you do that. Now, if someone has never invested in real estate before, we've talked about a number of different things. Like, you could own property in Mexico, you could own property around the world, you could own condos in Toronto, you could own homes in Toronto, you could own student housing. What do you think, Chukwu, if you're, you know, were to invest for yourself, or helping someone who is investing for the first time, what would be your recommendation on where they would be best served to invest their money?
You have to sort of know yourself, to be really honest, right? I can give you advice on how I am, but it really depends on how you are and what you can handle. Because I can tell you, okay, you know what? If you buy a fixer-upper and then you fix it up and then you rent it out, that's a no-brainer. The last time I said the homes that I personally like are semi-detached raised bungalows. If you remember from last year,
Uh,
those are my perfect personal favorites. You have some of those that don't even want to actually have property. We're talking about the rates and all that. But there's one that actually came up recently that I'm actually exploring, and it works well for this sort of market for people who just want to invest cash and be more hands off. And those ones are rent to own. right? But from the investor perspective. So right now I'm realizing in the market, you have buyers that would like to buy, but they can't afford to buy. And then you have sellers who want to sell, but then there's no one, I'm sorry, they can't afford to sell for that amount and there aren't enough demand. So if you were to sort of get into rent to own as an investor, you can pretty much take those same 1,000, 2,000 funds or whatever it is, create a contract with a potential buyer and have that person rent it out. And at least it gives you a bit of an escape plan. If you can write it up properly, like how much they're going to pay by at the end of the contract, that can actually work out very, very well. And it's a bit more hands-off than normal because they technically are renting to own. They have a lot more duty
Invested
to
in the property.
maintain that property. Exactly. So it isn't as stressful and you are getting a return on your cash as well. So that is another avenue that's pretty interesting now.
Yeah,
I think
that's a really interesting opportunity because you're right. With so few people struggling to be able to afford the down payment necessary to purchase, really their only option is to rent to own, which is going to create alignment between them and you to maintain the property and make sure they take care of it. Plus, I would assume that on a rent to own, they were paying a higher rate than they would normally pay for rent. Is that?
it depends on how you structure it, but you can. So you can have them pay a higher rate and incorporate that into the payment so they pay down the amount owing.
Yeah.
Or you can just have it like they put some money down. So in order to get into the contract, like for instance, let's say you need to put $200,000 down and they have 25,000. You can call the 25,000 a fee, right? And get 25 or 50,000 up front. It just depends on what sort of contract you're having with that person to get it done. And if all of a sudden, like, okay, let's say for instance, you have 200,000, you rent to someone, let's pretend there's no interest because you're insane, right? And that person only has $50,000. You can technically take that 50,000 but as a fee, right? That you'd be a little bit exploited, but I'm just bear with me. 50,000 bucks as a fee, you pay that, you put a $200,000 down on most properties at 20%, maybe a bit more. Now, all of a sudden now that person is paying significantly less than they would have paid if they were to actually rent it out. Sorry, if they were actually going to pay rentals, right? So let's say the rental's at 5,000. Now all of a sudden they're paying like $3,000. That's a saving of 2,000 to them. So depending on how long that contract works out, it can actually be a win-win for them and a win-win for you as well. And not to mention, if you set the purchase price, that property is going to go up in value, right? So if you're a smart investor, you'd want to make sure that you have a portion of that equity in the future. So think of it this way. You can get money back up front. If you're smart, you would charge a bit of an interest in that money that they pay added on to whatever their payments are going to be. And then you can also get money at the end as well. So when the property does appreciate, and it should in a couple of years, you actually get a percentage of that appreciation. And that's all that's happening. You're not even a landlord. They're still responsible for everything. So that's a really nice workaround for landlords.
Yeah, and then if they default, you basically keep the whole property. It's like the bank. It's
I'll spend there 50 grand.
yeah. Well, not necessarily the best case scenario, but you there's really no downside to it. Because even if they yeah, because it's not a rental contract, so they couldn't go to LTB.
Nope.
Yeah, and right now I would imagine that demand for rent to own is increasing dramatically. And you could like if they've got a down payment, yeah, they can put a down payment and it's lower monthly fee. Or what I think the bigger problem with most young people is they're earning good money, but they don't have the money for the down payment. So
Correct.
you can just be like, okay, no big down payment, but a higher monthly fee,
Correct.
and we'll effectively get your down payment through the monthly fees, and you can look at
You
different
got it.
different alternative ways of structuring it.
You
We do
got
have
it.
another question that's come in here. So it's coming through from YouTube. Keisha Nandu on YouTube asked, suppose you have 100K of retained earnings in your corp. How should one structure a real estate investment, 2 units in another province that cash flows about $900 a month plus principal portion of portion of the mortgage? Um, so they're generating, I think what they're telling me is they're generating $900 a month over and above their interest payments or their over the principal. So not the interest. And the how are they getting that with 100K? Do those numbers make sense to you, Chukwu?
It depends if that was their down payment, like they put down just 5% to buy a property and they rented it out.
Yeah, and
Then
they
if it's
have a large amount of it.
expensive, then that's probably it.
So how best would you structure it? So you've got the 100K in retained earnings. Um, So, which means that if they want to take, I can address it from the tax perspective, and you can address it. I don't know if there's any real estate questions that they're asking here. So your options are purchase the property under the corporation's name, which would allow you to take that 100K and invest it. The downside of that is you get the higher tax rate on the passive income. The hard part here is I don't have an unknown. What is the interest? What are so I'm like I'm a little bit confused by the question. So Keisha, if you're still watching on YouTube, and you can follow up with some more details on the question. But you have a choice of investing in the corp or taking the money out and buying the property person. If you invest in the corp, you don't have to pay personal tax to get the money out of your corporation, which means you still have $100,000 to put as the down payment towards the house. The downside there is getting a mortgage in a corporation is typically harder and typically a higher rate. That I've seen. I don't know if you agree with that, but historically, I've seen clients, generally speaking, either have to put a personal guarantee or pay a much higher rate, or both, when doing it through the corporation, because there's greater risk for the banks, because the corporation does have limited liability, which means the bank can only go after what the assets of the corporation own. They can't go after you personally unless you do a personal guarantee. So that is the downside of doing it through the corporation. The downside of doing it personally is if you took that $100,000 out of your corporation, and if you were in the highest tax bracket, if you were already earning 220,000, you're going to pay 54%, which means you're not going to have 100K to invest anymore. You're only going to have $46,000 to invest. So these are the questions that we have to look at as far as what's the best structure. But assuming that you're able to get the financing and get the money in the 100K is the down payment, get financing in the corp. The advantage you're going to have there is as you're generating this $900 a month over and above your cost, let's assume that that's the actual profit. You're going to pay some tax on that. We know it's going to eat up a big chunk of that, about $450 of that. But the other $450 can go straight into paying down whatever mortgage that you have. Again, if you owned it personally, you're going to pay whatever your personal tax rate is. So that could be up as high as 54%. It could be lower down to about 30%. It completely depends on what your marginal tax rate is. But same idea would be you'd have what's left over to pay down your principal. The big difference with a corporation is that in theory, you probably have other assets generating income or other non-passive assets that you're using to generate active business income that can be also used to pay down, in addition to the money you're generating from the property of the $900 a month. You might have other income that you're generating from consulting that you're doing that you can use to pay down that mortgage at a faster rate. So I hope that answers the question. Oh, look, we got a follow-up. Keisha says, sorry, didn't mean to confuse. Cash flow is $900 a month. Only mention the principal portion since it's not tax deductible. Okay, fair enough. So basically $900 a month is the profit that she's making over and above the carrying costs of the thing, which, I mean, that's a pretty good return, wouldn't you say?
Yeah, that's not everything. Why not? That's pretty good.
Yeah.
Replicate it a couple of times and you're laughing.
Yeah, exactly. I mean, you do that a few times and you're making more than you would at a full-time job. And with 100K down, I mean, what's the minimum down payment these days, Chukwu? I mean, it's got to be 20% for
anything. Actually, they changed it now. Before it used to be anything over $1 million was 20% down. I think it's up to 1.2 million. It's lower, kind of like 7% or something like that. They changed it.
Yeah.
So it's not as difficult as it used to be. It's actually a lot less. But it also depends on your credit. It depends on there's a lot more factors.
Yeah. Okay. So we got to follow up again. Could be Keisha, which says, is there a need to make a hold co for the best tax optimization? Currently, there's only one active income corp consulting. So at $900 a month of profit, probably does make sense to set up a hold co, or at least you're nearing the potential benefits. So a holding company, the benefit of the holding company is what we do with a holding company is if you have one company that's got both active and passive income, and you have expenses, the expenses will reduce unless they're not directly related to the passive income. Will reduce the active business income first. So things like your own salary and stuff like that. So if you have if you're doing consulting and you're taking your own salary out of the corporation, it's going to reduce the passive income, not the, or sorry, the active income, not the passive income, which means that the full $900 is going to be taxed at that 51%, as opposed to the 12.2%. So what often is done is you'll set up a holding company. So it's generating 900. So what is that? It's $10,800 a year in taxable income. What we would do is we would take $10,800 in salary out of that corporation so that the income of that corporation goes down to zero. So it's not paying any taxable income. So nothing at that higher rate. Now, because you took $10,800 in income from your holding company, you'll take $10,800 less of income from your active business, which means it's got more income, but it's at a lower tax rate. So the holding company allows us to, within reason, move money that would have been taxed at the higher non-passive income rate of 51% down to the lower 12.2%. So if you're truly generating, $10,000 that would be taxable at the 51% rate, then being able to move that over to the small business rate of only 12.2% is going to save us like 38% on $10,000, $3,800, probably going to more than make up for the additional accounting fees that would go along with setting up a holding company. Because really the only downside to having a holding company is now you got two corporations and you got to pay twice the accounting fees to do the work. So you need to be saving at least that much each and every year. And I would say in your situation, Keshav, it sounds like you probably would and could benefit from a holding company. Now, one of the other things that people do is we have seen people who have multiple homes do multiple holding companies, one for each home. Because some of that risk that you talked about, like if the place burns down, they're liable. But if you've got that in a holding company and the holding company has no other assets, the only person that's liable is the corporation that owns the asset, not you individually. So you can limit some of those risks with those issues with basement apartments and stuff like that. So those are some things to be aware of. So we got some more questions coming in here. That is the hold show done. If you have two apartments in your personal name, is it a good idea to transfer them to the corporation, and how would you do that? So I would say probably not. So the problem with doing that from a tax perspective is that you have a deemed disposition, like you're effectively selling them from yourself to your corporation, and you'd be paying some capital gains, which is less than ideal, number one. Might be some strategies to reduce that, but more importantly, what benefit are you getting out of moving them into a corporation? You would not really have any significant savings. As we said, the tax rate inside the corporation, could be higher, potentially higher than the tax rate that you're paying now personally. A lot does depend on what your personal tax rate is. I mean, if you are earning over 220,000 and you're into the 54% tax rate, then you could save 3% by moving it into the corporation. But that means to save 3%, you're going to have to pay capital gains now. So generally speaking, probably not a benefit. So the reason that you would normally purchase into the corporation is because you have the funds already there, and getting them out into your personal name would cause a tax event that you're trying to avoid. So that's why investing in the corporation works, is because you got the money there, and to get it out, you'd have to pay personal tax. You've already got the money out, and you're already invested, it's already invested. Transferring it into the corporation, probably not a good strategy, unless you're looking for some of those limited liability benefits. Because it sounds like insurance isn't going to be a tool to mitigate those risks, right, Chukwu?
You got it.
So that answers that question. We've only got about 7 minutes left. If anyone has any other questions, feel free to throw them in the Q&A. But do you have any like final words of wisdom, Chukwu, or things that, people should be on the lookout for, when they should be making moves if they are sitting on the fence, or should they be moving right now? Do you see this as the time to buy and that people are being too cautious?
If I were to tell you the time to buy, that would make me the realtor that I absolutely hate, right? It really depends. The thing about it, right, is that if you look throughout the GTA, outside the GTA, et cetera, you'd realize that there are different submarkets that behave a little bit differently. Sometimes the housing market like for instance, sometimes the condos might not be selling, but semi-detached properties might actually be selling. In one area, the rents might be going down, another area rents might be going up. I would probably say what's the most important thing to look at, okay, overall advice is that usually whenever interest rates tend to go down or people have a belief that the economy is going to be stable, that's usually the best time to buy something that's usually when things sort of go on the up. That's why I usually say my dog is just going off. Yeah, that's usually when things sort of like go on the upswing, right?
Right.
So I would recommend keeping an ear out when you start hearing like the interest rates are going down. You start hearing anything involving inflation dropping below 2%. If you start hearing any news about homes are beginning to sell more, that's also very key. That's normally when you want to start like getting very, very interested in jumping in. And then you also need to take a look at that area and see what's happening and type of home. What can you afford? What type of investment you want to look at? And yeah, whether you can handle it, renovations,
Yeah.
etc. So it's really timing. It's timing and knowing what you're capable of doing or what you can handle.
Yeah. So, I mean, getting back to the name of this session, best practices. So really like the key is know your area,
Yeah.
you know, know how much money you've got, so you got to have a great relationship with your brokers to know your area. You got to have, a good relationship with your lawyers to draft the contracts and the agreements with your rental. Know which issues you're going to be subject to, like knowing that student housing isn't going to be subject to the landlord tenant board is absolutely critical. Knowing what funds you're going to have available. So that's sort of step one. Working with the right professionals and getting sorted is sort of step two. And then making sure that things are structured properly from a tax structure is step three, I would say, from a best practice. Is there anything that you would add to that?
I would probably say don't try to get too involved in the news too much because a lot of times I realize that when I'm looking at the news compared to what's actually happening in the market, for one, normally those reports tend to be 1 month too late. That's the first thing. The other thing, take it with a grain of salt and understand what the news is there for. The news is meant to be sensational. So, for instance, we can see news that would say that sales are going down, right? But it might say the prices are going down compared year after year. So you might be saying like from last year, a home was sell for $1 million, and then last year is now selling for 900,000. But then if you look at month to month for the entire year, you might see that you might be saying it might be 850 in January, and now it's hitting 900,000. It's a completely different like view of where things are going. So you have to sort of like be aware of the terms, understand the news aren't really there for you to like gain knowledge. I would recommend talking to a professional and see exactly what it is. That's like, if you don't know, like if you understand real estate, you understand taxes and everything, that's good. That's a good start. If there's one part of it that you're not 100% sure of, talk to someone that knows what they're talking about and vet them carefully. Ask them the right questions and see if they know what we're talking about, if they can back up what they're saying.
Yeah.
It
Because
doesn't
they
take a
could
lot.
very easily, you might see a news article that, hey, sales are going up, but they're talking number of units, not prices, right? So maybe
Right.
the price is actually going down on the homes, but the number of units being sold each month is increasing. And knowing how to read the stats is important, and knowing which markets to be in, which again, Keisha from YouTube was kind enough to let us know that the property she was talking about is actually in New Brunswick and is
Ah,
rooming student housing model. So the numbers work much better there. So again, looks like, I love those small university towns because typically they're far more affordable. Cash flow is much better. And to see those types of returns, $900 a month on a $100,000 down payment, it's a tremendous return, even if there is no growth in the capital gain, which I'm guessing over time there still will be.
it will
So
be.
thank you, Keisha, for sharing all that. We do have a couple other questions which we'll try and get to we can understand them. So if you buy a pre-sale and put it in the corporation's name, and only a deposit is given so far, then you get a mortgage in your name. The loan this loan this money to the corporation. Is that the best way to structure it? The advantage of structuring it that way is effectively you would create a large director's advance, money owed back to you. But I mean, I'm not a mortgage broker. I suspect you would have a hard time getting it structured that way because you don't own the property, so you can't get a mortgage in your name. Again, I'm no real estate mortgage specialist, so talk to your mortgage broker about that. But Chukwu, I don't think you can do that, right? You can't get a mortgage under your personal name if the asset is owned by the corporation. I've never seen.
The only way you can do that is if you have like a personal guarantee of some sort. There's a way of pulling it off, but you need to have a personal guarantee. So there
Yeah,
is
but
a
it
way.
would still be a mortgage under the corporation's name with a personal guarantee. It's not a personal
Exactly.
mortgage.
Exactly. Yeah,
Yes,
and
maybe
not every bank is going to be good with it either.
yeah.
So yeah,
Yep.
talk to the bank.
Yeah, talk to your broker again. Bring in the experts. I'm not an expert when it comes to bank financing, but from my knowledge, you cannot do that. And got another couple of questions. If you want to help Sun down the road, it would be a transfer from Corp to Sun into Sun's name for principal residence. What are the tax implications? So if your son is not working in your business, not an employee, and you want to take the money out of your corporation, you're going to have to pay personal tax to get that out of the corporation, either in the form of a salary or a dividend in order to get it to them. If they are an employee of the corporation, there is something called an employee loan, an employee home loan. So there are ways to lend money to from the corporation to your son without it having to take a tax hit. Now that loan does need to be repaid, and that's typically repaid with a taxable benefit that goes on the employee's T4. And that's typically the best way to do it if you can structure it that way. So hopefully that answers your question. And I am the only director of the corporation. Yeah, so Sun doesn't have to be a director of the corporation to do a loan. This is an employee loan, not a shareholder loan. So yes, Sun as the employee is the best way to go. And you can give them a salary from the corporation, which is great from income splitting. Especially if they're going to be in university, they're going to have tuition credits, deductions. Giving them income from your corporation is going to be a great way for you to get it out tax efficiently, and also allow you to do home loans for them to get even more out for the down payment. Bank said shareholder loan to myself for the pre-sale. Yeah, that's because the bank doesn't understand the tax consequences of that. A shareholder loan would have to be repaid within 1 year, or it would have to become salary or dividend. So we do shareholder loans all the time. A shareholder loan is not available for a 25-year amortization the way an employee loan would be. So when we do loans for purchasing of a car or the purchasing of a home, those are employee loans, not shareholder loans. So you're getting them, you might also be a shareholder, but you're only getting that as your role as an employee, not your role as a shareholder. A very important differentiator because there are different rules for the different types of roles. So I think that we're a few minutes over time. So thank you, Chukwu, for staying with us and giving us your pearls of wisdom. Can I be an employee as a corp if I'm a director? Yes, if you're a director of your corporation, you can still be an employee. An employee just means you're getting a T4. So yes, you can still be an employee of your corporation. Great. Well, actually, so in closing, if anyone has any further questions and would like to connect with you, how would they do that? What's the best way for them to connect with you, Chukwu? Or if they're looking to get some research.
No worries. You can give us a call at 416-747-5825. That's 416 Sherlock. Or you can just send me an email. I can share that one. Broker, BROKER at Sherlock Holmes, SIRLUCKHOMES.com. or just Google Sherlock Holmes. SIR, like Sir, Luck, Luck, Homes. I'm not hard to find. I mean, I'm very easy to find. It's pretty
Yeah.
simple. With
Pretty
good
easy to
rating.
find. And the good news about your name, which I butcher, is that it's unique. So there's not that many of you. I put it in Google and I found you 3 links.
Instant.
The top 3 links were all you.
Yep.
LinkedIn, Facebook, and Realtor Portal.
Got it.
Yeah. So again, thank you. Was one final question. Are LTDs the same as a holdco? Um, maybe, maybe not. So LTD, so your corporation can have different legal endings. It can be LTD, it can be Inc., it can be incorporated, it can be limited, it can be corp, it can be corporation. But that doesn't mean that that company is or is not a holdco. A holdco, opco is a type of structure when you have shares of one company owned by another company. The company that owns the shares is the holding company, and the shares that are owned by the holding company is the operating company. So LTD doesn't necessarily mean anything, unfortunately. It's just a legal ending type of corporation that is available here in Canada. You can have, like I said, LTD, Limited, Inc., Incorporated, Corp, and Corporation. Those are the types of legal endings. You do have to have one of those legal endings, but it can be any one of those. And again, I'm just going to take a quick look because I think there's some stuff going on in the chat. I have an appointment in 25 minutes in my son's school, so I have to run. No problem. Oh, that's from you. We are at time. So thank you, Chukwu. I will let you run to your school's appointment, your son's appointment, and I'm sorry to read that out loud. Everyone, have a great day. Thanks again, Chukwu. We'll have to have you back again next year, and maybe we'll bring on a mortgage or a mortgage broker as well who can talk about some of the financing criteria.
I can help you with that as well. Anything you need.
Awesome. Okay. Thank you, Chukwu. Have a great one.
Bye now. Bye, everyone.
Bye.